And welcome to Real Talk on Real Estate. And we're live on YouTube, TikTok, and we're live on Instagram. First time we've been live on Instagram since our account got shut down. And it took us about, let me see here. Pow. Okay, cool. Took us a month to get that account back up. So now, today, I wanted to go over something specific, and I'm just kind of streaming. And this is all for YouTube. So YouTube, welcome to our Real Talk on Real Estate. And I'm streaming this on a few different platforms, so we get a couple thousand people that watch this over the course of the next day or so. And so people have been asking me, Jerome, do landlords need to raise rent right now to save the commercial real estate market? And the answer to that, I'm going to go over in multitudes of different ways as we go through this training today. And I want to kind of share with you guys a little bit about what's happening in the real estate market. And I'm going to give you guys some truth to that, but then I'm also going to give you guys some opposition to that as well, and kind of share with you a little bit about what's happening in the multifamily sector, from a small scale to large scale investors. So people that have a few doors to people that have a lot of doors, hundreds of doors, thousands of doors, and what's happening, what we're seeing from a micro level to a macro level all over the country, okay? And I'll kind of share with you what the feds have told us about what the year looks like right now in regards to interest rates and how that affects us as investors and banking and lending and all of these things, because they all kind of go in sequence together. And so, ladies and gentlemen, one of the biggest issues right now is in vacancies. And I've been talking about this for a long time. In fact, you could take the exact same piece of real estate, with the exact same walls, the exact same tenants, the exact same carpet, the exact same exterior facade, the exact same swimming pool, parking spaces, amenities, everything. The lease rate in the entire place can stay the same. It can even go up a little bit. And in spite of all of those variables staying exactly the same, there's a bigger factor that affects values on real estate larger than just what the real estate looks like. Now, obviously, you want to be able to keep that real estate full, and you want to be able to keep it at a 95, 97% occupancy, because that's what most rental properties have been bearing over the course of the last 5 years. And so keeping it above 95%. In fact, I'm stabilizing right now my Youngtown project that we just finished about 4 months ago. It's a 104 unit adaptive reuse project that I picked up an old office building. We turned it into 44 units of multifamily, and then we added 60 new units of ground up development. We tore down one building for a total of 104 units. We took a $1.8 million piece of shit office building and we turned it into a $30 million apartment complex. And we did that over the course of 2 years. It took us 2 years from the time we actually bought it to the time we actually repositioned it. And right now we're 87% leased up, and we got about 60 days to get to 95%. And so we're doing a HUD loan and we're stabilizing that at about it's actually a 5.9% interest rate. And we are seeing that we might actually be able to get down to closer to 5.5% interest rate with a HUD loan. So really cool. Now, right now, those type of rates are unheard of in the traditional lending sector. In fact, so much so that it's even really hard for us as developers to get these projects to pencil financially, to be able to turn dirt and let banks give us the leverage that we want and need to be able to get out of the ground. Otherwise, we're having to come out of the ground with a $50 million build with $20+ million just to turn dirt. And so the value of that asset, if interest rates just go down a little bit, goes up exponentially, and then we need less money to actually build that asset. It's the same thing with value. So look at, ladies and gentlemen, I'm kind of teaching high level today. So don't lose me here, because if you guys lose me here, it's going to affect how you guys look at real estate from a small micro level to a big macro level. So follow me here, ladies and gentlemen. Now, okay, assets. Same cabinets, same countertops, same walls, same exact tenants. No difference in the tenants that live in the building. No difference in the occupancy of the building, even if it's sitting at 95%. No difference in the rental rates of that building. But yet, real estate today versus 2 years ago is only worth 50% the value. And you're sitting back going, holy shit, Jerome, what did you just say? That's right. Same everything. And real estate rates are only worth 50% of the value. So what's the answer? Do we double rent rates to make the values go back up? Is that what the answer is? Do landlords just poach from people to be able to get these rates to go back up? Now I'm pulling out a calculator, ladies and gentlemen. And the reason why I'm pulling out this calculator is I want to do some math here with you guys. Okay. Now, the way that commercial real estate is valued is based on income. Okay. But the income has to be able to service the debt on that asset. Okay. So follow me here. 2 years ago, we were able to get interest rates on a multifamily apartment complex at 3%. Okay. Today, it's closer to 6 to 7%. Let's call it 6%. Okay. Now, same walls, same tenants, same occupancy, same rent rates. Nothing is different. The way you assess value, ladies and gentlemen. Now watch. Once you guys understand this, I'm going to talk about when it is the best time to rent, how investors should take the slow end of the market and take value in those arid times to be able to parlay their rental sales. And I'm going to go over a component related to affordable housing that can help tenants and also landlords, both. Okay. So we're going to end with that. I want you guys to understand this, because once you guys understand this, you're going to have an epiphany. You're going to be like, holy shit, Jerome, I had no idea that was the case. Okay. So watch. Take this for example, okay? Value, write this formula down. Value equals net operating income, which is abbreviated NOI. So if you ever have somebody say, hey, what's the NOI of the property? That's your net operating income divided by your cap rate, okay? Now, I'm going to go over what an NOI is, and I'm also going to go over what a cap rate is and how you assess those two things, okay? Now, because value is equal to that. So if value is the equivalence of the net operating income divided by the cap rate, shouldn't you know what a net operating income is and a cap rate is? Because this is the way banks and financial institutions look at the values of assets. So when you go, Mr. Banker, Mr. Banker, Mr. Banker, hey, I need a loan for this asset that I want to build, buy, or sell. And if you can't get a loan on it, you can't sell it. If you can't get a loan on it, you can't buy it. If you can't get a loan on it, you can't build it. So understanding this is the crucial element to being able to underwrite commercial real estate and predominantly multifamily real estate. Okay. Now, what net operating income is you take all of your rental rate, right? Like, remember I said, all of everything that we're doing is exactly the same. Same rental rates, same tenants, same occupancy, same everything. You take all of the gross revenue that comes into that property. So you take the rents, you take what's called your rubs, like pet fees, deposits, credit check money, garbage dumping money. If you charge people for parking stalls or garages, you take all the revenue that property comes in, including like laundry, all the coin laundry, all of that stuff comes in. Now, that is your gross operating income, okay? What's up, TikTok? You guys are killing it, man. Loving you guys. Okay, so you take your gross operating income. What's up, Instagram? It's nice to be back. Love you guys too. And YouTube, I always love you guys, man. You guys are always giving me love. Okay, so you take all of your gross operating income, all the income that property brings in, okay? And now you have expenses. You have property taxes, okay? You have insurance you have to pay. You have lights that you have to pay. Now, the tenants are paying their own light bills. They're paying their own utilities for their own individual unit. But who lights up the parking lot? Who pays for the sales office? Who goes out and pays for the water for those things? So you take all of those expenses that property bears. The landscape guy with a blower outside blowing all the leaves and garbage off the property and cleaning it every single week. Okay? You're taking all the expenses, the broken light bulbs, the toilets that are clogged, all of the expenses, and you add all of that stuff up. Now, when you add up all your expenses, you subtract that from your gross operating income, your gross income that comes into that property. And then that gives you your net operating income. The only expense that is not included in your net operating income is your mortgage. It's the rate you pay for money, for the lending. And most banks own 75 to 80% of those commercial assets. So now in today's world, banks don't want to have that high of risk. So they're only lending 65 to maybe 70%, 60 to maybe 70% loan to value instead of what they were lending prior 2 years ago, because there was a lot more upside to these properties. Now, not as much. Okay. Now follow me here. I know this stuff gets a little bit boring, but this is crucial. If you're a real estate investor and you really want to understand how to buy commercial real estate, this, ladies and gentlemen, is the golden tool to buying commercial real estate. If you don't understand this, you might as well just throw in the towel, because now you're rolling dice. This isn't a crap game. This isn't a luck thing. This is like real business. This is the way banks look at lending right here, ladies and gentlemen. So pay close attention. Now, you take that net operating income. Now, let's say that you have a property, and let's say that property brings in $180,000 a year in revenue, okay, in rental revenue. Now, let's say you have $80,000 that it takes you to run that facility, from paying property taxes, paying insurance, paying all the expenses that property bears. That leaves you with a net operating income of $100,000. Okay. So let's assess value. We take $100,000 and we're going to divide that by a cap rate. Now, a cap rate is the amount of money. That's like your return on investment. So if you go to the stockbroker and you say, hey, Mr. Stockbroker, what does Walmart bear in interest on average over the last 5 years? And he goes, well, Walmart's been bringing in 6% on average. And that's what your return on investment is. If you go in and you say, hey, what's the return on investment on GMC or Amazon or any publicly traded company? That's your cap rate. The return that it bears you is your cap rate on real estate. And so cap rates, the return that your real estate brings you, has to be in alignment with lending. Because if you can't afford the note, then the property will go into bankruptcy. So cap rates and interest rates have to run in parallel to each other. And so 2 years ago, when interest rates were at 3%, properties could sell for as low as a 3% cap rate, okay? So if we take $100,000, guys, and we divide that by a 3% cap rate, okay? Now, what I always tell you guys is when cap rates go down, values go up. When cap rates go up, values go down. Same walls, same building, same paint, same carpet, same everything, same tenants, same occupancy, same rent rates, same revenue. Nothing changes. Everything is identical, ladies and gentlemen. The only variable, the only difference, ladies and gentlemen, is the cap rate itself based on interest rates. Look at what it does. This, ladies and gentlemen, is gold, because here's what happens, ladies and gentlemen. Here's what happens, okay? You have a net operating income of $100,000. Remember, value equals net operating income divided by cap rate, okay? Cap rates run in parallel to interest rates, so you could sell an asset at a 3% cap rate 2 years ago when interest rates were 3%. So you could still afford the debt, and you still have 3% return on investment. Now, nothing to brag about to be able to own an asset with a 3% return, but look what the value is, okay? So you take $100,000, 100, and you divide that by 0.03. The value is $3.3 million, guys. $3.3 million. Okay. Now that's a 2021 number. Okay. Now let's look at it today when interest rates are between 6 and 7% in the traditional market. Okay. Now we're getting HUD lending. It's a government assisted loan. And so when you get a government backed loan like HUD, you can get slightly better rates. They're still not incredible, but they're a little better. But let's call it a 6% cap rate, even though interest rates are slightly higher than that. And so if we take that same $100,000, guys, 100,000, punch that back into your calculators. Okay. Check my math on this. Now, 6% cap rate, because it's 6% interest rate. I can't service a 6% interest rate with 3% cap rate. It doesn't make enough money to service the debt on that bad boy. Bankruptcy. Okay. Now we take a 6% interest rate. We have to take a 6% cap rate. The asset can't sell for less than it can service the debt on that asset, right? Because then if it doesn't service the debt, who's servicing that debt if it doesn't have enough revenue to service the debt, the expensive money? You are. Get a second job, because Ding, 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 ding. You're the now proud owner of what I call trash can money, money that you have to throw away to the bank every month because you're working for it and it doesn't service its own debt. Okay. And that's what's happened in real estate markets. So watch, look how this works. Let's take a 6% cap rate on that same asset. Is it better from a cash flow perspective? Yes. You're making 6% versus 3%, but look at what happens to the value. So you take that same $100,000, you divide it by 0.06, the same everything, guys, walls, interest rates, everything, all the same, the same walls, the same tenants, the same revenue, the same occupancy rate, everything's the same. But the value went down to $1.66 million. $1.66 million. Ooh, that is all, ladies and gentlemen, that a bank will lend on. And that is the 100% value. So really, the bank will only lend you money on, if you're lucky, 70% loan to value right now. So let's take times 0.70, okay? That means that a bank will give you $1.16 million to buy that asset. But yet, if you purchase that asset just 2 years ago for $3.3 million, and even if you had a mortgage that was $2.5 million on that asset, a bank will not give you more than $1.16 million to purchase that asset. You either have to buy it at an inflated price and pay for the difference, but you can't refinance. If you want a better interest rate, if you want to get some money out of that thing, you're screwed. You have to sit in it. So the only people in real estate that lose are the ones that can't weather the storm. So I always tell people, we buy and hold. We don't buy to sell, we buy to hold. We buy for the long haul. And so for us, we just want to be able to build these things, stabilize them, and then sit on them, okay? Now, I guess you can double your rents, right? Like landlords can go in there and try to double their rents, but then guess what happens to your tenants? They disappear. Now, truth be told, if you go in and you look at the National Apartment Institute across the United States, they say that over 50% of tenants stay in their lease for an average of 3 to 4 years. And that 1 in 5 tenants stay in their lease for an excess of 8 years. Now, if you push rent rates too much, they're just going to disappear and they're going to go someplace where rent rates are better, especially right now. So there's a lot of inventory coming to the market because builders did go crazy for a little bit. So now there's an absorption rate that's taking place. Now, is there still a housing shortage? People are sitting back going, well, Jerome, I thought you said there's a housing shortage. There is, but you don't just snap your fingers and just go boom, boom, and the apartments go do. It ain't like the Jetsons, right? You guys ever said the Jetsons back in the day? Right now I'm dating myself. Remember, they just like press a button and just go and a building just goes up and then boom, it's alive and everybody's living in it. That ain't the way real estate works, guys. There's an absorption rate time that it takes to actually fill that building. Like we finished our Youngtown project in November. So November, December, January, February, March, April, 6 months, guys. And we actually started leasing it in August because half of it was done in August. So we landed up going August, September, October. So we landed up 9 months, guys, to get to 87% filled. And we still have 2 more months to get to 95% filled. That's when we sit back and go, okay, we're leased up. We're stabilized. Now we go in and we stabilize our long-term loan and we get a better interest rate. We have more cash flow. Our value goes up and we're able to go out and stabilize it, sit in our loan, and then just let that bad boy cash flow. Okay. That's what we do. Then we depreciate it. We don't pay taxes. That's for a whole different day, guys. Whole different day. Okay. Now, so we want long-term. The main goal is to stabilize these assets. That's the main goal. We want to come in, we want these assets to be stabilized, and we want the cash flow. That's the goal. So if we have to stabilize the 6% cap rate, who cares what the value is? Because long-term, historically, over 100 years plus, one thing has been consistent. Real estate and its values have continued to go up exponentially over the course of time. And so this is just a small bump in the road for values. Interest rates go back down. Rent rates will continue to slowly climb. We're not going to just pound people, okay, to be able to go in and ping them for more money. I'd like to get a little bit more money. If the government prints more money and puts more money in your pockets, then it raises inflation again, right? That's why interest rates haven't stabilized. That's why they're not allowing interest rates to go back down. Now, if interest rates go back down, even if they just go down to 5%, look what that does to the value. You take that same $100,000 and you divide that times 0.05, that goes back up to $2 million, guys. Not bad, right? Like it's not 3%. It's not that $3.3 million value, but it goes back up a little bit. So now the value of your asset slowly starts to climb back up as interest rates come back down, allowing investors to refinance, sell, and purchasers to come in and start buying more real estate, right? Right now, the hardest thing for investors is lending. Okay, now the good thing for investors is that if these products go into bankruptcy now, you can go in and steal them because you can get them at today's values because that's only what they're worth to the bank today. So if it needs to be offloaded and these banks need to get rid of these assets to be able to shed this dead weight off their books, it's a perfect time for investors to buy. That's the good news about today's current market. Okay, now, and I predict that over 300 local, regional, and community banks will go bankrupt over the next 2 years. You guys watch. The Feds had talked in December about interest rates dropping up to a full basis point over the course of this year. They were going to do 4 interest rate reductions. Now, we're in April, ladies and gentlemen, and now the Feds are talking slightly sideways. They're sitting back and they're going, look, we don't know if we're going to be when and how we're going to be able to lower interest rates because unemployment is still very low and inflation is not where we want it to be at that 2% annual year over year. So because of that, we're going to be very cautious. And so now Mr. Jerome Powell is saying, well, ladies and gentlemen, I still promise that we're going to work on trying to get to 3 interest rate reductions. Now it went from 4 to 3 this year. And they also made a disclaimer that they're not sure if indeed that will even happen, but Mr. Jerome Powell is going to work on it. Okay. So that means that real estate prices are still going to stay really, really low. And they're trying to do that and press on this. Now, the good news is that when you look at the S&P 500, you look at the NASDAQ, you look at the Dow Jones, there's 2 companies that control these assets, guys. It's Vanguard and BlackRock. Okay. It's a scam, right? Like this is the way the US works. It's like a monopoly almost, where the 3 largest trading companies in the United States, the dominant traders in those 3 sectors is Vanguard and BlackRock. And BlackRock invests money for our Federal Reserve, which is crazy. They take your guys' money and they invest it and lose it. Now, listen to this, guys. Now, one of the biggest investments that these companies have is real estate. And in fact, if you take CBRE, both Vanguard and BlackRock together own 17%. They're the largest stockholder in CBRE. Now, if you take Extra Space Storage, which is the largest storage company in the nation, they own 16.3% of Extra Storage Space. They're the largest investor in the largest real estate transaction sectors in the United States. Okay. Now, is this just so that they can shed off the small guys and then and dump all this real estate and then come back up and clean house and stack to the bottom line of their portfolios? Are they going to shed all these investors off and then they're going to clean house and buy it? Or is this also going to affect them as well? Now, I think it's going to affect them as well. But long-term, ladies and gentlemen, if you can write off $1.7 trillion that you've lost and not even anybody in the general public hears about it with like BlackRock did, I think they're going to be able to shed this stuff off and just dust it off. Now, it would seem that would be the contrary, but that's not necessarily the case. Okay. So ladies and gentlemen, hang on for your dear life because I think we got another year to 2 years of commercial real estate absorption to really hold on to, which means you ground up developers, including myself, we're going to have a hard time getting lending still. Now, are we getting lending? Yes. Is it a pain in the ass? Yes. Are we having to come to the table with more money and more equity? Absolutely. Is leverage real shitty right now? Yes. They're not giving us the leverage that we want. So we have to either raise that capital privately or use a family office or private credit to be able to come to the table with that stuff, or these products don't get done. But we're making it happen. You can too. The good news is the values are down and it's time for you to buy and sweep up pieces in discounted prices. Okay. Now, let's look at affordability components, because this is very important when we talk about commercial real estate in regards to a tool that can be utilized both for tenants and also be utilized not only for tenants, but for landlords. Okay. Now, one thing that you guys have probably heard me talk about is how most of our multifamily, we add what's called an affordability component to it. Now, you got to be strategic, because there's two things that affordability components can do. If they're federally backed affordability components and you have an affordable, like by the code, by the governmental rule books, a governmental affordable housing project, you have to fit into the governmental sector of the definition of quote unquote affordable housing. They take the average living wage, and what they do is the rent rates are based on that average living wage. And so they take a median of that average living wage, and that has to be a rent rate. Now, what you have to be careful about with affordability components is that they can also bear upon you rent caps. And if they bear upon you rent caps, that means that your rents get capped at a certain level, and you don't know when that cap is going to be raised or stay until the economics of that city you live in goes up and the average living wage goes up. You are capped on where that rent push can go, which means it's going to cap your value of your asset. Even if interest rates go down and cap rates go down and values go up, your value will go up a little bit, but you can only go up to a certain degree. It's not like our assets that once the economy allows and we can push rents $100, we push them. That means our net operating income goes up. When our net operating income goes up, our value also goes up, right? Because value equals net operating income divided by cap rate. So both those two variables, net operating income, cap rate, are both direct factors on values in real estate, ladies and gentlemen. Okay, so when we go in and we do an affordable housing component to ours, we only do a 15 to 20% affordable housing, and we just have to make up to 15 or 20% available for lower income people, which means we can still push rents. We have to give it to them at the average living wage, but I can rent it. Like, we just don't advertise it that much. But if someone comes in and says, hey, Mr. Jerome, your management company says that you have affordability components to your multifamily, I can't sit back and say, no, tenant, you don't get that. I have to, if I have my apartment complex and 15% of it isn't available to them. Now that's the key word, guys, available to them, which means I can go in and lease it up to 90%. And the thing that you have to realize is that there's a 5% revolution in tenancy every single month. So we attach an affordability component to it. We take tax abatement incentives from our local municipal counties to be able to take that back and take a shedding off of property taxes or other incentives. But that's one component that we look for. When we go in and we do an affordability component, we're trying to look for something as well. We're looking for free property taxes. We want tax abatements for 5 years, 8 years, 12 years, whatever it is. We want that free tax abatement, because guess what also happens to our net operating income when we don't have to pay taxes? That's no longer an expense. Our net operating income goes up. That means what happens to the value? Ding, 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 ding. The value goes up, ladies and gentlemen. And value is a direct correlation of net operating income and cap rates. Okay. Now, when we do this, ladies and gentlemen, we go in and we will lease everything at full market value. And if somebody walks in and says, hey, I need affordable housing, I'm low income, I need to be able to have an affordability component added to my lease, then we have to make that available to them. So if there's a 5% revolution every month, and 90% of your leases that come in that month are those that are to people with affordable housing components that they qualify for, you have to make them available to them first. If you haven't leased up that 15 or 20%. Now, if only 4% or 20% or 30% come in, then the rest of that you can lease at fair market value. Okay. That's why I love it, because now we can fill vacancies. We can fill vacancies with people that are low income without compromising our net operating income. It just adds to our occupancy rate. Okay. So ladies and gentlemen, there's a ton of tools. Now, if you guys just listen to me talk, I can sit back and we can go for hours upon hours upon hours. Some of you guys will fall asleep. Some of you guys will get excited, but each and every single one of you guys, when you have your ears open, your brain open, and you're paying attention, will learn. The biggest thing I want you guys to take away from this today is that there are moving pieces to commercial real estate. And there's so many moving pieces and so many options and variables. When you learn these things, it protects you against bankruptcy. It protects you against losing properties. It protects you against your property values going down and allows you to thrive over the course of time. And the end goal is to win financially and invest in commercial real estate. Ladies and gentlemen, if you like this content, smash that friggin' thumbs up button, pound and subscribe to our YouTube channel. And ladies and gentlemen, thank you guys for joining us on our Real Talk on Real Estate. God bless you guys. Good night, and go out and compound your success.